Hi friends, welcome back to Murthy Finance Academy. Today we will discuss three key players in the pre-engineering space. So the first company which we are going to talk today is Interarch Building and Solutions. But before we start, a quick disclaimer: I am not a SEBI registered analyst. So whatever the companies we are going to discuss is purely for educational purpose. Please do not consider it as a buy or sell recommendation. So now let us start. So Interarch Building Solutions, with a 43-year legacy and rank as the number 2 player in the Indian pre-engineered building space, Interarch has built an execution mode that peers find difficult to replicate. Its proprietary brands, TraceDeck and Trace, combined with a one-stop shop approach, create high switching costs for the customers. For industrial clients, the cost of failure is astronomical. They prioritize Interarch's 4-decade reputation over low-priced, unproven entrants. So the company's core revenue mix comes from three areas. So first segment is industrial and logistics segment, where it focuses on warehousing, manufacturing plants, and EV factories. So it, this sector mostly dominates in north and south, but now it is also expanding into Western India, I meant to say. So second is new sectors, wherein the company is helping in building pre-engineered buildings for semiconductors, data centers, and renewables. So here high growth, and it is having a nationwide presence in this segment. And coming to third segment, it is institutional, wherein it re-engineers multi-story commercial like G plus 16 floors, airports, tier 3 terminals kind of a thing, and lounges kind of a thing, where major metro hubs are there. So there it is concentrating. So India is at the inflection point of a structural shift from traditional civil construction to PEB, driven by strategic mandates of speed to market and green building compliance. Management asserted that the current market is just the tip of the iceberg, which is backed by 100 times potential as steel intensive designs replace concrete across industrial landscape. So while large conglomerates like L&T and Shapurji have attempted to penetrate this niche, their lack of specialized focus led to historical failures. As management puts it, why can't a steel manufacturer directly get into making a machine? It is as different as that. So here PLA schemes in electronics and massive semiconductor announcements are forcing compressed project timelines. This urgency shifts the buyer's focus from price per kilo to speed of commissioning, favoring Interarch's integrated model. And there is also a China factor playing positively for this PEB segment. Is Chinese imports are a non-threat due to the necessity of local engineering coordination and adherence to Indian or American standards. However, in heavy structures where India faces a supply gap, imports remain prevalent, a gap Interarch is aggressively targeting with its capacity expansion. So Interarch is executing a strategic pivot toward high complexity buildings, moving away from commoditized industrial sheds toward high margin institutional and tech infrastructure projects. So the current pipeline now consists of 15% data centers and multi-story institutional buildings. Key wins in this in recent times include semiconductor units for Tata and Micron and specialized steel making plants for JSW, JFE. And in multi-story specializations, the company is now bidding for ground plus 16 structures, signaling a move into high-density commercial steel. So here, the company is also planning to export. So Interarch's export strategy is an intentional play for higher realization and lower execution complexity. It is expanding to Myanmar and Ghana, where current high margin wins, where company provides design and manufacture services without the burden of local erection management. And it also has a presence in North American pipeline, currently in partnership building phase with a 3 to 4 months window. And exports command higher margins because payments are secured immediately upon supply, eliminating the long tail risks of domestic project management. So in Q3 fiscal year 2026 represents a quantity driven growth phase for the company. The fact that volume growth nearly 43.8% almost perfectly mirrors revenue growth, which is around 43.7%, is a smoking gun for operational efficiency. It proves that Interarch is scaling through sheer throughput rather than fluctuating steel prices. So in fiscal year 2026 quarter 3, the company generated revenue of nearly 523 crores, compared to 360 crores in the previous year, with a 43.7% year-on-year growth, purely led by volume-led outperformance. In EBITDA also, the company generated 42.9% year-on-year growth, which showing strong operational leverage. And coming to PAT, it also reported a 32.1% rise in profits, but though it impacted by one-time cost like labor code changes. So, but the PAT margin took a 70 basis points hit, mainly due to a 3.5 crore one-time impact from new labor code gratuity adjustments. This is an accounting artifact, not a cyclical decline. And if you see its CFO to PAT ratio also for fiscal year 2025, it stands at around 0.5 times. While a 50% conversion would normally raise eyebrows in Interarch's case, it reflects heavy working capital absorption required to fuel a 40% plus growth trajectory. So, with 200 crores plus in cash and zero debt, the balance sheet is pristine. Okay, so now the high velocity growth meets a fortress balance sheet. Minor margin friction from labor codes is a distraction. The core efficiency machine is generating record volumes with clean collections and zero bill discounting. So if you see its order book now currently around at 1685 crores, which is sufficient for 9 to 10 months visibility. And its hit rate is nearly 21%, which is stable, reflects selective bidding. And working capital cycle is also around 34 days, which is best in class operational control. And the company is having a target inflow of 2100 crore plus, which is an aggressive run rate for fiscal year 2027. So investors generally mistakenly view the 3 to 4% quarter on quarter order book growth as a slowdown. That is incorrect. Management executed 160 crores extra orders this quarter compared to last year. They are intentionally capping the book at 10 months to protect their reputation from timely delivery execution is the current bottleneck, not demand. And management also displays a demanding authority and consistent under promise over deliver style. So previously the company guided for revenue of 1720 crores, which was blown out of the water. The revised 1900 crores target represents a massive 10% outperformance. And it also raised 100 crores via QIP. The preponing of the Gujarat and AP phase 2 plants by full year is a proactive strike to capture closing window in high complexity steel. And the company is also betting on 500 crore potential from 45 metric ton capacity realization is a healthy, confirming the move into high value engineering. And while engineering is a core strength of the company, management made no mention of AI driven design for or automated project management. This remains a potential gap for future proofing operational margins. So in summary, leadership is exceptionally conservative but operationally aggressive. The elevation of Manish Garg to executive director signals a deepening professional management, ensuring continuity as the company scaled towards a 3,500 crore capacity. So Manish Garg is a CEO, so now he got elevated to a executive director position as well. So coming to valuation, Interarch is the only pure play PEB listed entity according to conglomerates like comparing to conglomerates like L&T or KEC in this category. So company is now currently trading at around 22.7 times with the ROCE of 24 times, which is a pure play PEB debt free company. So Antararch is still being priced on its old 17% growth guidance. It is currently delivering 30% plus growth with a sector leading 24.8% ROCE. The market has not yet priced in the upcoming 285k metric ton total capacity. So relative to its 40% volume growth, the stock is objectively cheap. Investors are getting a debt-free, high ROCE capital goods play at a significant discount to slower growth EPC conglomerates. So what are the key red flags in this company are steel price cyclicality. While protected by a 4-month inventory pipeline lag, sudden 30 to 40% spikes cannot be fully passed on instantly. And second is land acquisition risk. The second Gujarat plant requires additional land estimated to nearly 7 to 8 crores. Any delay derails the fiscal year 2028 commissioning timeline. And third is execution dilution. Preponing capex requires hiring design teams and project managers 6 to 9 months in advance of plant operation, which may cause short-term margin bloat before revenue catch up. So if you see a basic SWOT analysis, the company is having a nearly 43 years of history in this space, history which is acting as a moat, zero debt, 200 crores plus net cash, and volume growth matching revenue are key strengths. And coming to weaknesses, CFO to PAT shows high working capital needs, and pending land acquisition for Gujarat P2 project, and sensitivity to sharp steel price spikes could be weaknesses for this company. And opportunities are high margin US Canada export pipeline, 100 times TAM in structural steel conversion, specialization in data centers and semiconductor plants are key opportunities for Interarch. Coming to threats, short-term margin dilution from rapid capex, competitive intensity in low complexity sheds, potential slowdown in private capex could be threats for this company. So what are the key monitorables which we need to watch in the next coming days are Gujarat Plant 1 commissioning, whether they can hit their target by July 2026 or not. AP heavy structure phase 1, which is expected to start commercial production by September 2026. QIP deployment, tracking the whether 100 crore fundraise and immediate deployment into AP and Gujarat phase 2 projects or not, we need to check. And order inflow run rate, they are targeting of 2100 crores plus run rate for fiscal year 2027. And export margin realization, whether the first meaningful revenue from North American partnerships will be fruitful or not, we need to check. And Manish Garg's board impact, assessing operational continuity under the new ED structure, all these are need to be tracked by investors. So the company is now firmly positioned to lead industrial infrastructure cycle for the next decade. This is what I feel about Interarch. So if you have any comments, please put down your comments in the comments box. I will go through them and I will try to answer them as well. So if you like this video, please do like, share, comment and subscribe to Murthy Finance Academy. Thank you.